Like all crypto networks, there are a lot of challenges. I think DePIN has a unique set of them. On the physical side, probably one of the largest challenges is running a hardware-based business. There's typically a little bit more centralization risk that can occur with a hardware-based business. Unless you have many suppliers of that hardware, typically it would come down to maybe one or two centralization points that could come down to. So if you have one supplier of the device, then that device manufacturer gets taken out, and then the whole network is potentially disrupted.
Hey Mike, welcome to the Open Metaverse podcast. How is your day going?
The day is wonderful. It's Friday, and so the weekend should be starting pretty soon. And yeah, excited to be here. I appreciate you inviting me on.
I appreciate you coming. So Mike, to kick things off, why don't you tell our audience a little bit about your crypto origin story and also about Lattice Fund?
Sure. Yeah, I think like a lot of people in crypto the first introduction typically is Bitcoin. I found out about it not through stumbling across the white paper, but really, when the Silk Road was becoming more popular, first heard about Bitcoin at that point of time, and some friends were transacting on there, buying some Bitcoin, and when Coinbase went through Y Combinator, or just came out of Y Combinator, that was the first time I bought some Bitcoin myself. So back in 2013. But, unlike some people who were maybe a little bit smarter than I was and caught the bug at that point of time, it was a little bit more of a casual interest. I bought some Bitcoin, kind of followed it up through that big spike during that time period, and then the crash after the Silk Road collapse in Mt. Gox, and kind of casually observed it for a few years. I was working at Facebook at the time, so I was pretty busy with that, and Facebook was booming, so it was a pretty exciting time to be working there. And I didn't go super deep on crypto at that point. And then, but I would casually observe it, and I still have my Bitcoin in my Coinbase wallet. And then in 2015, I met the founder of a DeFi project called IDEX, Alex Weirn, who, at one point in time, it was the largest decentralized exchange on Ethereum, post Ether Delta, pre Uniswap. And, this is 2015. I think the ICO for Ethereum had just happened pretty recently. And, I said, I just met him. What are you into? And he said, I'm into Ethereum. And I said, well, what's Ethereum? And he was like, he started telling me about it. And then he was like, you should go home right now, sell all of your Bitcoin and buy Ethereum. And I didn't go home and sell all my Bitcoin and buy Ethereum, but I did go buy some Ethereum at that point of time. And it was just kind of an interesting time to buy it because, it was pre all the ICO mania. Not a lot was happening necessarily, but, it was kind of this early days. The DAO hack had just occurred. And I feel like it was fortuitous to buy it at that time. It was like pre run up. And when the craziness of the sort of ICO mania happened, and I started like digging in deeper to everything that was happening in the ecosystem and learning about it, I felt like this was a good next opportunity in my career to make a transition. So I had been at Facebook for quite a long time, had been looking for the next thing, didn't want to go down the sort of traditional path, going to the next like big tech giant. So like, a lot of people go to Pinterest or TikTok or Snapchat, what have you. So I was looking for like just a totally new paradigm, and Ethereum and broadly crypto felt like that. So I met the founders of a company called CoinList, which is a spin out of AngelList, and was formed when Protocol Labs wanted to do the Filecoin offering. So they partnered with AngelList, built a platform to do a regulated offering with accredited investors only. And so the company was spun out outside after that sale in order to do more crowd sales. So I met the founders. They were like, "Hey, we need someone to run sales and business development." And I said, "This is perfect." And left Facebook, joined CoinList, and I joined CoinList at the absolute top of the market. So it was spring 2018, and basically from the moment I joined, it just went like everything just collapsed. A lot of people were questioning if crypto would stick around at that point, but it was fortuitous. There was a lot of smart people, both at CoinList and people that I was interacting with. And that's also where I met the co-founder of Lattice, Regan Bozeman. So, sometimes like one thing doesn't work out, but it's meant to be, and other things will start to work out. So yeah, moving on to Lattice. So stayed at CoinList for 4 years. During that time, met my partner Regan. So I was working on the deal sourcing and diligence for teams who go on the list. So we listed a bunch of layer 1 blockchains like Solana, Flow, Blockstack, Celo, Immutable X, probably 24 large infrastructure projects. And Regan was, once those deals were closed, he was responsible for making sure they were successful in launching their token. So everything from marketing, fundraising, deal structuring, legal, foundation setup, really like kind of had to put all the pieces together. And him and I became, close through that process from a working relationship standpoint. And then in the depths of crypto winter, fall 2019, I had this idea like, hey, we should organize a crypto ski conference. And we threw up a landing page and just said, hey, like, we're going to host this thing up in Tahoe. If you're in crypto and want to come, you should come out. And it was a great event. We had about 50 people come out, a bunch of other fund managers from the space, the guys from Framework, Kyle from Multicoin, Lasse from 1KX, a bunch of founders. So the co-founders of Dune Analytics, OpenSea, and a whole bunch more came out. Had a great time. And Regan and I realized, hey, we like working together. We should do more. So we started investing together as angels at that point of time. Had the chance to work with a bunch of great founders through that process. So the OpenSea guys, Dune Analytics, Audius, and did probably maybe roughly 24 deals through, let's call it, mid 2020 through the bull market of 2021. And then at the beginning of 2021, Regan had left CoinList and started DevMetrics, which he then went on to sell to Masari. We said, hey, why don't we take what we're doing and professionalize it more, go out and raise a fund. So summer of 2021, we went out and raised our first fund. That was a $20 million vehicle. And, spent most of the rest of 2021, early 2022, investing that in roughly 20 to 30 startups at the seed stage. Yeah, having a great time. The bull market's over. Bear market is a much healthier time for investors like us to be investing. So excited to be doing it. So yeah, that's a bit of my crypto journey to date.
Quite a journey, Mike. Quite a journey. Funnily enough, we had Andrew Steinborn from Sephrimion, and his crypto origin story also kind of started from Silk Road. That's how he got the Bitcoin bug, and then led to NFTs. So you did mention CoinList. I remember when I joined crypto, I think during 2020 to 2021, anything that got listed on CoinList was all the rage. So just also want to pick your brain before we jump into some of the meatier topics. So in terms of the due diligence and some of the projects that used to get listed on CoinList, what were some of the criteria, maybe on-chain metrics or data points that maybe you looked into whilst you were there to get projects listed or for the launchpad?
It was interesting because at that point of time, there weren't any on-chain metrics because most of these were entirely new blockchains. And in many cases, they were launching with a white paper. So if you look at even going back to the Filecoin sale in 2017, and they had a white paper, nothing was built. And they only went on to launch it, several years later. That evolved over time, partially due to securities regulations, because if you're launching something on a white paper and selling it, it's pretty clear it's a security. So over time, it evolved to the point where we would only do a token sale if a team was ready to launch mainnet. But what that meant is there really there wasn't a whole lot of data. And because these are the layer one blockchains, like, well, what are you working with? So a lot of this was kind of the typical stuff that any maybe seed stage investor might look at. So who's the team, kind of what's the proposed tech? If it's a layer one blockchain, obviously the addressable market is pretty large. But if it wasn't a layer one blockchain, like what is the addressable market? What has the team built so far? And like what traction could they demonstrate? So for a layer one blockchain, maybe it would be like, what validators have they lined up for their incentivized testnet? Do they have developers hacking in some capacity on a testnet? And there was some beta version. So these were all things that we looked at. But because like these projects, by the time they got to CoinList, maybe had gone through 1 or 2 rounds of financing, another benefit that we had was, the signal that was associated with the project. So had certain investors already invested in it, how much money had been raised. So that was through all of those things, we could kind of triangulate on the projects that we'd end up going on to list. And we had a bunch of, really successful projects go through. Most successful ones were ones that launched, at least for investors, were ones that launched during the bear market. I think the most famous, obviously, is Solana. They did an auction on CoinList 2 weeks after COVID broke out. Worst possible time ever to run a token sale, and raised, I think, around $1.8 million at 22 cents a token. So for the 200 or so, roughly 200 to 300 people that participated, pretty amazing opportunity to generate returns. Even now, after the decline in price on Solana, it's pretty spectacular.
Excellent, Mike. So now I want to double click on some of the more philosophical issues. So what attracted to you from Web3 in terms of unique business model or unique value proposition Web3 opens? And what was that attractive factor for you?
I mean, Web3 really wasn't even a concept whenever I joined crypto. We hadn't come up with that name yet. For me, the attraction to the space was really just, it was entirely open, or felt like totally new. So coming from, being in San Francisco and Silicon Valley, there's these very, you have big tech companies that have been around for a while, tried and true business models that have been tested over time, and a machine of people and systems and funds and accelerators that all kind of already existed. They had been there for a while. And granted, like, new things pop up, but like the institutions, the startup world had that infrastructure had been laid for a while. And crypto, with both its ecosystem and the business models that it's proposing, and how how it pushes value out, not just to kind of these centers of this nexus of power, but also pushes it out to the contributors in various capacities, was really attractive. So I didn't really, at the time, like, it was actually a little bit hard to understand, but just felt like very new and different. And I didn't really know where crypto would go, but I think that was probably what attracted to me. Like, it felt like the other paths were somewhat formulaic, and I was looking for something that had a bit of an unknown destination. And I still think we're, somewhat in that camp of a bit of an unknown destination. I mean, things are clearly working much more than they're working at that point in time. But it's I think the unknown that was the most interesting aspect to it.
Yeah. Whilst I was looking at your portfolio, you guys have invested in a lot of interesting projects that kind of captures that theme of social coordination, or if you contribute to your network, you do get some rewards. So we'll touch upon DePIN in a bit. But the two projects that kind of caught my eyes were Delphia and I think Karate Combat, which recently also kind of launched. So maybe for our audience, maybe we can zoom into those two projects to kind of hammer in the point with regards to social coordination and how, if you contribute to network, you somehow get incentivized.
On the Delphia side, you hear a lot in crypto about the value of user data and how users should own their data. They should be able to monetize it. They should, receive the benefit for that. And I know that, better than a lot of people, because I was at Facebook, and like, Facebook was better at harvesting user data than just about anyone. And that user data was tremendously valuable. Now, what Facebook did is they translated user data into ads targeting which then big corporations could use, or big and small corporations could use to attract users to buy buy whatever they're selling. But that's the real challenge, is like, how do you take user data? It's like this oil, and refine it and make it valuable and something that can be actually used, and you increase the monetizability of it. Because user data on its own, it's like, if I have user data, like if I give it to someone, like what are they going to do with it? It's not like there's not like a whole lot that you can do with it. You need either scale, or you need to enrich it in some capacity. So the Delphia team, comes from a financial background. What they realized is, if you look at most hedge funds or Wall Street investment banks, they're using user data to enrich the algorithms that they use for trading purposes, whether it's indexing, tracking, or just any alpha that they're looking to generate. So what Delphia attempted to do, and it continues to attempt to do, is to combine user data from the people on the platform plus the algorithms that they've generated for their trading strategies. So if you contribute your data, so let's say your Amazon purchasing history, your credit card data, and there's kind of various tiers, you could unlock access to various funds or better yield by contributing the data, and can, in aggregate, instead of them going out and finding a data broker to buy that data from, they're allowing the users to contribute themselves and then share in the upside of the better generated returns from investing and using that data. So this is a way where, like, you're not getting paid directly for that data. So it's like, hey, we'll give you $5 per month for access to your data. Instead, they're saying, hey, we can generate better returns. We'll share those returns with you. We just need you to provide your data in order to allow us to do that. So that's on one side. And I think that's something that is lost in probably a lot of projects, where it's just like, hey, user data on its own should be valuable. And probably in many cases, like, there's some value, but for the average person, maybe it's a few bucks a month that might not be that interesting. But is there a way to enrich it or make that data more valuable, provide value on top of it? Again, how do we share value with the people that are generating it? In this case, it's using financial trading strategies. On the other end of the spectrum is a project called Karate Combat, and this is a team that launched a new combat sports league. So most people are most familiar with things like UFC or MMA, and what they saw at the time is there's a gap in the market for karate. But most people in globally are familiar with karate and the practice and the discipline. But there wasn't a global sports league centered around it. And our philosophy is that in the future, as new leagues are developed, it's much more likely that fan participation and the people that ultimately make the league valuable and exciting. Obviously, you have the fighters or the athletes, but like the fans are that's what really creates it. And figured out more ways for them to get involved and benefit from that involvement. So in the case of Karate Combat, they have a token. The token does a number of things, but the two most important pieces to it are governance. So you can do things like choose who will fight in a certain match against each other. Maybe what they wear. It could be even things like what music they might come into. And the other piece is kind of a betting component. So if you're familiar with a project in the DeFi space called Pull Together, they have this idea of a no-loss lottery where you can put up a bet, and then you don't risk that bet, but you share in the upside of if you do actually win. And this is the same case for Karate Combat, where you can bet on matches, but you're not actually risking the initial collateral that you put down. So they've kind of coined this phrase called up-only gaming. And our view is this is a perfect match for a crypto audience, because it's male, it's generally younger, which matches really well with crypto. And you kind of combine these two things together, give them more participation and rights in the league, and they're likely to feel that ownership even more so.
I think this leads us to a perfect segue into DePIN. So earlier with Delphia, you kind of highlighted the value of the fact that if you kind of contribute your data, you can get some kind of upside. I think DePIN kind of plays into a similar theme, where if you're early in helping set up the network, if the network does take off, you kind of reap the benefit eventually in the future. So kind of a similar thematically. So we'll want to love to learn more about DePIN from you. So for our audience, can you elaborate what is DePIN? And I know you guys have invested in few DePIN related projects. We'll also love to learn more about those.
Sure. So DePIN is a new category in crypto. It's only, I think, about a year old at this point of time, at least the name DePIN. And Sammy from Masari was the first person to come up with the term, but it's gone through several iterations. So Multicoin wrote a blog post, I think about 2 years ago now, with their thesis on proof of physical work. And that was kind of tied to their Helium investment. And Helium was kind of the first project, I think, that kind of blended the physical and digital or on-chain world, but it's evolved quite a bit since then. So they wrote this thesis on proof of physical work. Then about a year ago, we put out a blog post on, we kind of tried to come up with a new name for it. Felt like proof of physical work was a bit of a mouthful. So we came up with this name, TIPIN, which was token-incentivized physical infrastructure networks. The idea that you were using token incentives to coordinate physical infrastructure in the real world, whether that's wireless networks or energy, and then allowing for the contributors to the network, those setting up this physical hardware, to benefit from whatever revenue stream would be driven from that physical hardware. And then I think several months later, Sammy from Masari came out with the phrase decentralized physical infrastructure networks. Is like all things in crypto, they are decentralized. And that's gone even through several iterations. So the first one was like really talking mostly about these more hardware-oriented infrastructure networks. So you had wireless, so projects like Helium and Pollen. You had things in the weather space where you'd set up things like weather vanes, like WeatherXM, geospatial measuring with these satellite monitors, things like GeoNet. And then it evolved from there to more digital resource networks. So on that side, like you have the physical, and then on the other side, you have digital resource networks like storage or compute, which are all kind of categorized in this broad category of decentralized physical infrastructure networks. And they both have like their nuances. So, for the physical side, one, like hardware is typically a component of it. So you actually have to set up physical hardware somewhere. It's usually location dependent. So there's going to be certain locations that are going to be more valuable than other locations. So maybe, for a wireless network, having an antenna set up in downtown Manhattan is way more valuable than having it out, way out in the middle of nowhere, because there's no demand for that wireless connectivity. And the final aspect is that there's, fungibility of the assets. So it's like different. Like if you have, storage, it's like storage is storage. It almost doesn't matter where it comes from. Whereas with a physical resource network, like actually where it is going to create a difference in the value of it. So there are definitely differences in these two, and the category has definitely evolved over time as both new projects have launched, and as I think the space has broadly started to think about like, okay, what makes the most sense to categorize into this decentralized physical infrastructure network. So you have both the physical side, and then more like the digital resource side with things like storage and compute and databases, etc.
Perhaps, Mike, you can also highlight a couple of projects that you have invested in this category and what those projects are trying to do.
Yeah. So when we raised our first fund, Helium was really the only project at the time that I think we classify as DePIN, at least on the physical side, not the digital resource. And we wanted to find more. We thought this was a really novel way to bootstrap a new infrastructure network without a lot of upfront capital from one centralized entity. And we met a team called DIMO, which was building a decentralized mobility network focused on putting hardware devices into vehicles to collect user data. So this kind of goes back to the theme that we talked about earlier, and provide that data to both application developers and also companies that just would want to access that data for monetizing purposes. So it could be insurance companies, it could be other car companies, battery manufacturers. Then you could also build a whole host of applications on top of this mobility network. So it could be decentralized car sharing, it could be creating new insurance models, et cetera. So we invested in them. Right now, they've scaled up to about 20,000 vehicles connected over the past year. They're doing everything from like creating games on top of the network, or the idea that every vehicle becomes an NFT that's on chain. Those vehicles then can be paid for various purposes. So you can start to see like where the on-chain components and the off-chain hardware device get tied together. So that's DIMO. They launched their token maybe about 9 months ago, so that's live now. Another investment that we made is a project called Daylight by a team called Anode Labs. Daylight is building is a decentralized energy network. The hardware component is multifaceted. The first piece is a energy monitor that gets put on your electrical panel in your home. What that does is monitors your energy usage patterns at a baseline. So you can start to see, okay, how much energy am I using? What rooms, what devices are actually draining the most energy? And if you look at the way that energy is actually monitored by the grid, in most cases, like there's very archaic systems where they can't get real time energy usage patterns. So they can start to sell this data both back to utility companies and then also similar to DIMO, like financial companies that want access to energy usage data in certain geographies or cities, or even at the country level. You hear a lot about grid flexibility or grid demand, rolling blackouts in the United States because there's too much strain on the grid. And what's happened is companies are starting to form what are known as virtual power plants. And what a virtual power plant is if we can combine all these energy assets, so let's say a home battery and a thermostat, you can start to contribute to the grid. So when it's under high demand and they need more energy, and you have energy assets like batteries storing energy, you can actually supply the grid with that energy and start to monetize. So what Daylight's doing is using token incentives to not only get that energy monitor into place, but say, hey, if you add solar here, if you add a home battery, you can hook this up to a virtual power plant and further monetize that energy asset. So there's a couple of trends that are super important here. One is the movement towards clean energy. So I think around the world everyone's quite familiar with climate change and global warming. So there's more alternative energy production that's taking place, whether it's wind or solar or hydro. And Daylight's contributing to that by incentivizing users to make that transition on their own and not just kind of rely on third parties and where they capture that energy from. So they just went live on testnet now, so you can purchase the initial energy device, the energy monitor. Soon they'll be adding things like the ability to add batteries and thermostats, but no token is live on that one. But that's one you can start using and testing out, at least if you live in the United States.
Amazing. So Mike, have you guys looked into, or are you guys investigating in a same vein, decentralized compute? Because you talked about multiple themes that you could play with Daylight, for example, climate change. I feel like with decentralized compute, there are also opportunities to play multiple themes, such as rise of AI, rise of metaverses, spatial computing. So maybe we'll love to get a download. Maybe you are investigating this space. Maybe you have made a couple of investments, but they're kind of in stealth mode.
Yeah. So we've definitely looked at the decentralized compute space over the past year, even prior to, I think, the excitement that has occurred around the rise of AI. So we've looked at projects like Jensen, Akash, and Render, And I think they all do some really exciting stuff. Our viewpoint on the decentralized compute space is that we think it's likely to be verticalized in some capacity. So there's some specialization that occurs as opposed to generalizability. So we're starting to see this a bit more now with, for instance, Jensen is really just focused on AI, Render on this 3D rendering, although I think they're also trying to get into the AI space. But looking at projects that gravitate towards one modality of customers that they're serving, not only because they can likely serve those customers better, but just by better understanding that market, the challenges that those companies are specifically facing, having networks to sell into. So looking at the background of the team of like, is this a team that can sell into companies in that vertical, or companies that we'd be excited about. So we haven't made any investments in decentralized compute space just yet. Definitely one we're monitoring pretty closely and trying to figure out if there are opportunities. I think one of the challenges at this point, for a fund like Lattice is, we tend to invest at the earliest stages. We're pretty valuation sensitive, and just given the excitement and like some of the hype around AI, I think the best time probably to have invested in this would have been like a year or two ago. Right now is definitely like it's feeling a little bit frothier.
Yep, that totally makes sense. One comment there would also be it's so with these projects, I think it's also very tough at an earlier stage. It's also very tough to look at the distribution or the demand side because they are the earlier stages, right? My viewpoint is even though things will get verticalized, whoever owns the distribution here will have a huge advantage. And I know a lot of Web2 projects, despite not having a Web2 cloud computing service, they do have access to peer-to-peer networks or access to gaming computers for whatever ways they can obtain. So I think that is something I feel like will also be very important for this vertical. So Mike, why do you think this DePIN is such an important vertical given the current crypto landscape?
If you look at a lot of crypto, you probably classify it in two ways. There's inward-looking problem solving. There's outward-facing problem solving. There's still a lot of people both inside of crypto and then outside of crypto, certainly, that are like, what exactly is crypto solving in the world? You have maybe the Bitcoin folks on one side that are solving money problems, but a lot of like the founders in crypto are mostly looking at, well, what are problems in crypto that I can solve? So whether it's scalability problems or MEV or how do you trade tokens that were created on chain specifically, they're very much internally facing problems that anyone in the rest of the world is probably like, why does that actually matter? But eventually you have to start looking at outward facing problems, and it takes a unique entrepreneur or founder to say, well, okay, here's this problem that exists in the world. I know this because I've been operating in this space for 10 to 15 years. And this is a way that actually crypto can solve that problem. So whether it's token incentives, whether it's using smart contracts in some capacity, they have a unique insight that is differentiated from a founder that's purely trying to solve a crypto-related problem. So while we're totally comfortable investing in projects that solve crypto-related problems, and we invested in a number of them, we're also quite attracted to finding entrepreneurs and founders that can look outward and say, here are problems in the world. So, let's talk about climate change or the siloing of mobility data and say, there is a way to use crypto to solve these things. So I think you need both. It's definitely not going to get, these aren't going to get done with, one without the other. But if we always solve inward facing problems, then eventually you'll say, okay, well, like there needs to be some connection to the rest of the world. So, we haven't made as many investments on this side, but you're already seeing this with the rise of reward assets and the interest within DeFi of bringing things like treasuries or securities or real estate on chain, because those are massive addressable markets that if you can only, if you can bring on a small percentage of them, it dramatically increases the size of the crypto footprint. And then also makes a lot of the existing crypto infrastructure, whether it's exchanges or money markets that much more valuable because you've on-ramped more value onto the platform. So, we like finding entrepreneurs that are tackling problems that not only address problems within the crypto world, but also uniquely address some problem outside of it.
Yeah, totally get it. Last week I was trying to explain my friend about MEV. It's definitely not skeuomorphic, some of the crypto problems we have. Yeah. So Mike, I would also love to have a download on some of the challenges you see with the DePIN sector. I have a whole list that I would love to discuss. So maybe we'd love to know your views, like what are some of the big ones that you see with this sector?
Like all crypto networks, there are a lot of challenges. I think DePIN has a unique set of them. On the physical side, probably one of the largest challenges is running a hardware-based business. Now, granted, once they get large enough, they can start to get third-party suppliers to actually build the hardware and distribute it for them. But if you talk to any startup that's trying to run a hardware-based business, crypto or non-crypto, typically it's like one of the most difficult spaces to be in, just due to cost and also supply chains that need to manage on a global basis. Like, just not very easy. So that's one big challenge is that these teams face. I think another one is that there's typically a little bit more centralization risk that can occur with a hardware-based business, because if you're manufacturing hardware, unless you have many suppliers of that hardware, typically it would come down to maybe one or two centralization points that could come down to. So if you have one supplier of the device, then that device manufacturer gets taken out, and then the whole network is potentially disrupted. So there are things that teams are doing to try to address that, mostly around getting more access points or more suppliers of their device. But that's another one. I think another one is that because these are outward facing problems, they're typically also being addressed in some capacity by some incumbent or other startups that are rising in the space. So, looking at more of the digital resource sides of things like compute and storage, you're going up against Amazon, Microsoft, Google, and even within crypto, you talk to the average startup founder, they're like, oh, I'm fine using Amazon for compute purposes. Like, unless they really, really either philosophically are aligned with decentralization at every point of the stack, Amazon works quite well for them. Maybe at some point in time, they'll think about decentralizing everything, but, for now, the database, we'll just use a centralized database. So that is probably one of the biggest challenges. These are outward facing problems. These problems have probably been addressed in some capacity by an incumbent or a startup that exists, that works pretty well, that doesn't have some of the baggage of crypto rules tokens, and maybe it's a little more complicated, and people can rely on them. So that's probably the largest challenge that exists, is the demand that exists for this product or service is probably already being served by some incumbent. And how do you get people to switch over unless you're offering something either 100x, 10x better or 10x cheaper? It doesn't work to just say, hey, it's centralized. That's typically not enough for the average consumer. They want to have some better experience. So that's probably the biggest challenge facing the space. And I think that's up to each individual team is to kind of sort through what is the unique value proposition that they're adding in order to address, what is, an incumbent that's already, already potentially owns that market.
Mike, very well articulated. And I think you covered the switching costs. You also covered the demand and the supply side. I think that was very well covered.
I'm curious to hear your challenges are.
Yeah, I think the biggest one is the way I kind of think about this is it's like a triple-sided marketplace. It's not like a dual-sided, especially with the hardware piece. So when we talk about DePIN, things like Helium, if you think about it, it's triple-sided. You have to first have the demand side, then you have to have the supply side, and then you also have to get the hardware component right. So getting three-sided of the marketplace is difficult. But I think once you're able to do it, then the business becomes very defensible, and then you start to see the network effects and then have a moat. But I think a lot of entrepreneurial, I think, will struggle setting up those three-sided marketplace with that three sides of the network effect. So I think that's one. And you mentioned switching costs from incumbent. I think the user inertia cost is also very higher. Like convincing somebody who's a dev who has been addicted to AWS, telling them, okay, switch, let's not use AWS, let's use Render or let's use some of the other network. I think it's difficult for them from a habit standpoint. So I think those are the two big ones that come up. And then and the monetization as well, like demand side monetization, which I think it's kind of a no, it's an early topic to discuss, but we haven't seen that. But that's because the network hasn't had that escape velocity. But I think that is still to be determined on how does, from a token standpoint, the demand side get monetized. We'll be yet to see that play out with Render or Helium or some of the projects out.
Yeah, the demand side is always the place where we go first with any project that comes in to pitch these things, because we've clearly demonstrated that tokens are a powerful incentive, and people will do a lot of things in order to earn tokens. So supply is, has historically not been the problem here. It's really been generating demand. So it's an evolving process. And I think teams are a bit more pragmatic about it now. Like Helium ran like really the first experiment of this, where, they had these token incentives. They launched it in the bear market when honestly they couldn't give the devices away. No one wanted to install these things. But once it like captured some momentum and people started to look at it and they got excited about it, it almost like got ahead of itself because the demand wasn't there yet. So teams and the founders, for instance, one thing that a lot of teams are doing now, instead of launching tokens, is they'll run a point system. So similarly, people like to compete for more points. The expectation maybe down the line they'll get an airdrop. What that means is they can start to tweak the business model and figure out demand and that true product to market fit in an environment where they're not giving away so much of the network supply. It also helps with securities risk, because you're not giving tradable assets. But that's probably one of the biggest tweaks I think teams are making is like, hey, let's spend a little bit more time like figuring out product market fit, figuring out the demand side, not giving away tokens for kind of useless supply or supply that's not that valuable, and taking a kind of a more slow and pragmatic approach to launching these networks.
Absolutely. I'll also highlight one point that I've seen, especially with decentralized compute. I've seen decentralized compute projects. I've seen that there's a conflict of interest between token holders and equity. So, for example, with some of the decentralized compute, you have a SaaS-based business model. So, for example, on a monthly basis, if you're paying some dollar amount, you get access to priority compute. So I think that is also one issue that a lot of these businesses will have to solve. Like it can either be a SaaS model or it can be a token model, because then you have this inherent value accrual issue that which entity or which side of the equation gets better value accrual. And I feel like that is also one of the challenges in their tokenomics that they need to kind of solve for.
Yeah, and this is, going back to the DePIN model challenges, there are legacy business models that demand side businesses are used to paying on a subscription basis or a very straightforward API call basis. And they definitely don't want to get involved in tokens. So a lot of teams have done a good job of like extracting away the complexity of dealing with tokens, but it certainly does, like, at some point in time, you do have to deal with, like, well, where does that value go? And are there trade-offs that take place because, token value is appreciating, not due to necessarily, like, actual network demand usage. It's more based on speculation. And then the people that actually need access to the network are paying, premium only because people are speculating on the network increasing in value, but not because the actual value is there yet. So, these are, I think, unique challenges to crypto more generally because of tokens. But the defense space, because like there's some asset like storage or compute, and people are used to paying. They want to pay a certain price because they baked it into how their business operates. Like they don't want to, they certainly don't want to deal with that variability.
Mike, fascinating discussion. I do want to switch topics now. I recently read your report on 2021 seed stage introspection. I think you guys posted on Twitter and also on your blog. So perhaps enlighten us what you have found. Feel free to share your screen and tell your audience how do you kind of see the fundraising landscape evolve and some of the insights there.
Yeah. So the project started because it's a bear market. We've got more time on our hands. So what we wanted to do is look at every 2021 seed stage team and see if there were any investment opportunities, from that batch. So there were about 800 companies that raised money pre-seed or seed rounds in 2021. That was looking at like height of the bull market, if you will. And we wanted to do a follow-up and see, okay, like company A, what's happening with them? They launched a token. Have they shipped a product? Like, is this worth reaching out to them? So as we started working on this, we're like, hey, this is actually pretty interesting, maybe more broadly for the entire space to understand, hey, we invested $2.6 billion in 2021 across seed stage. Like, what happened to all of it? Like, where did these companies go? So our initial expectation, just because there was so much, I think, maybe irrational exuberance during 2021, like a lot of these companies would have maybe disappeared or like they've quietly shut down. And I'll pull up my screen. Within this database, you can see all of the companies that raised in 2021, when they raised, how much, what ecosystem they launched within, sector, subcategory, if they've raised a follow-on round, and then if the token launched. So what we, initially wanted to see and share is like, well, are there differences between the ecosystems? So like, do Ethereum-based teams ship more than Polkadot-based teams? Or so we've categorized the data in that capacity. So you have both ecosystem and sector and subcategory, and then did some of these teams raise a follow-on round, and then did they launch a token? And then I think probably the most important category, which we haven't exposed in this database, we kind of have at the aggregate level, is like, did they ship a product to testnet? Have they shipped a product to mainnet or mainnet equivalent if it's not an on-chain product? And then have they found product market fit? So if you look at the report, which I'll share now, for each of these, we break down, for instance, this is the distribution by stage. So I just mentioned, like, have they shipped a product? So roughly 70% of companies within the 2021 vintage have shipped a product. You say, well, is that good? Is that bad? How do I even benchmark that? So I think probably like the most interesting data point is like roughly 20% of teams have shut down. But if you compare that to startup industry norms, so non-crypto startups, it's roughly in line, if not slightly better. And what we calibrate, or what we classified as shutting down, is if a team, specifically said on Twitter, hey, we're shutting down the project, this is no longer going to exist, maybe remove your funds or do whatever you need to do. Or, they hadn't posted to any social channels in greater than 3 months. So I think that was another good sign for the industry that, despite all of the challenges over the past 12 months, many of these projects are still shipping, they're still delivering products. And then probably the most important thing is like, how many of these projects have actually found some semblance of product market fit? So you can see here, there's roughly, we had about like almost 5% of projects out of the 800 that found product market fit. You would probably say that's like plus or minus 1% on each side. Some people would be maybe a bit more generous. Some people maybe a bit more conservative on, how many teams are finding that product market fit. But it's really elusive. So, maybe an NFT marketplace during 2021 found product market fit, like they're crushing it in volume, but with the NFT bear market that we're in now, like, do they still have product market fit? Do they have to kind of shift to a new market? Do they have to just kind of keep chugging along? So that can be a little bit tricky to define, because in crypto, like the markets move pretty fast, not just prices, but also like user trends and how people are using products. And it might feel like you had product market fit, especially if you're using token incentives, and then at some point of time you realize, actually, like, maybe we don't. Another kind of cool takeaway is probably a little too hard to see, within the sectors. So infrastructure, probably no surprise. We had designated as, being more successful in finding product market fit. I think, it's a bit easier within crypto. Consumer products are still quite challenging to launch. Like you hear a lot about now, like, why do we not have more consumer use cases, more social apps, more, more apps that kind of match the Web2 experience? But it's challenging. It's similar to the DePIN projects. Like if you're a social app, you're going against incumbents that are, well-oiled machines that have scaled to billions of users. You have things like Twitter and Facebook and Instagram and Snapchat. Like those are amazing experiences from a consumer perspective. It's hard to pass those up. Whereas infrastructure, like I'm attracting developers to build in a new way that they've never been able to, build before. You're offering them something different than a consumer experience that maybe is, like you said, skeuomorphic to what already exists within Web 2. So that's probably
Mike,
another.
I also, this sentence also kind of stood out and caught my eye. A lack of clear product market fit did not hold projects back from launching token. So a lot of projects in crypto, even though they might not achieve product market fit or they might be close to burning out all of their cash, they would perhaps launch the token. So maybe this could be a tell sign for a lot of investors out there, retail investors out there, to be really careful in terms of what they're investing.
There's a friend of mine who kind of jokes around, once you launch a token in crypto, usually that becomes the product. And that's what you start to optimize around. So, if you think of a product like, let's say you made a new soda, you'd think about, well, where's my distribution? I need to have it in Whole Foods. I need to have it in, various supermarket chains and bodegas. And similarly, like if you launch a token, it's like, well, my distribution is our exchanges, and I need to get people to talk about my token. Like that becomes the product. So it's a real like dangerous path to go down. We totally recognize the value of tokens and how it can, be used to, incentivize the community, get people involved, share an upside. But like there's a real danger at launching a token too early before you found product market fit. And then that just becomes a trap. So particularly within gaming, and a lot of these games haven't even launched yet. Most of these teams launched a token, they didn't even launch a game. And that's just a difficult path to go down because, not only are you, like if the token price has gone down, you're dealing with that situation. But like if you change your game or you change your product and now you get this token that's meant to do something on the network, does it make sense anymore? And then you have to go out and change it. So there are some risks. You even see someone like OpenSea, like, despite what's happened with Blur, and some of the market share that Blur has taken away using a token, like OpenSea still hasn't launched the token because they're really laser focused on finding product to market fit that's sustainable over a long time before launching a token into market. So for us, like with teams that we advise, we really try to push them to hold off on launching a token until they've at least gotten to the early stages of, finding product market fit, and a token really pours more fuel on that fire in order to scale it up.
Yeah, I think teams have to be really careful and differentiate between product market fit and liquidity market fit. You can have a strong narrative that kind of attracts liquidity, but doesn't necessarily mean you have a strong product to go by.
But yeah, the report, I think, I won't go through the full thing, just I don't think we have enough time, but it's definitely worthwhile to really, get a kind of a bird's eye view of what happened with that 21 investment class, what ecosystems seem to be making more progress than others, and then what sectors are, finding more success than their counterparts. We'll follow up next year with 2022, and most likely we'll have more ecosystems. We'll also have more, more sectors to dive into. Like even within this one, you have consumer kind of all lumped together, but because consumers starting to segment into things like more NFT related applications or more games, we'll probably start to break it out into specific subclasses just to get how much money is flowing into each of the subsectors.
So Mike, cognizant of the time, just a final question before we conclude the podcast. What are some of the themes and vertical moving forward you are excited about? So, and also if some of the projects are listening to this podcast, they can reach out.
You hear a lot in crypto that it's still early. And we definitely believe that. It is still early. And we look at how early it is probably on two dimensions, both user numbers and then value within crypto. So for us as a fund, we're looking for projects that we think can either address one or two ends of that dimension. So either something that we think attracts a lot of net new users into crypto in some novel way, particularly if they can attract users to participate and share on the upside in a way that doesn't just require them to buy into the space. So like, okay, I have to just go on Coinbase or Decentralized Exchange and buy tokens. That's my way to participate. So that's why DePIN is really interesting to us. It's like, I can plug this device into my car, I can put this in my home, I can set up this antenna. Like there's a way to actually participate and share in the network and earn tokens and be a part of it. Not just go and buy tokens and then kind of wait and see what happens. So that's, from a user perspective, anything that like on-ramps net new users in novel way. And then on the other end of the spectrum are projects that we believe introduce more on-ramps and liquidity into the broader crypto ecosystem. So that could be anything from payments to cross-border remittances, really anything that increases the liquidity, within the crypto ecosystem. So, particularly even within B2B, where you're on-ramping more capital than you would simply by just looking at more consumer-oriented use cases. But those are kind of like the two ends of the barbell. And then like everything in between is just like, how do you make crypto more better, faster, cheaper, and easier to use?
Amazing, Mike. Thank you so much. This was such a fascinating discussion all in all, and I thoroughly enjoyed the chat. Again, thank you very much for joining us to the Open Metaverse podcast. We'll hit your Twitter links and the blog below so our audience can follow you and perhaps ping you if they're working within those two verticals or within those two spectrum.
Awesome. Well, thanks for having me and have a good weekend.
This podcast is for information purposes only and should not be considered as financial advice. Any opinions provided in this podcast reflect the views of the speakers only.